So whoever can't make it. All right, so listen, everybody, thank you guys all very much for jumping on this webinar tonight. I've got my good friend, Daniel Patton here. Dan, how's it going, brother?
I'm doing well. I'm doing well. Thank you so much for having me. A welcome distraction for sure.
Yes, it is, and a well-needed one for sure, right? And I mean, look, we planned this webinar, like over a month ago, and obviously based on everything that's been happening in the market, I mean, this is perfect timing because we're living in unprecedented times right now. I've got lots of questions. I'm sure there's a lot of people on the call that have a lot of questions as well too, right? And so let me just give a quick little introduction to Dan. And if everybody on the call doesn't know who Dan is, Dan Patton is a mortgage agent. He works with Butler Mortgages, and recently he's a mortgage agent that is now part of Smart Home Choice. And one of the things that we like, with Smart Home Choice is to always kind of partner up with some of the best experts out there. And Dan's been a mortgage agent now for 18 plus years.
18 years.
With Butler Mortgages, who was #1 last year, right across Canada. Not even just Ontario, right across Canada. And then Dan, you were number 14 out of all the mortgage agents.
Yes.
Incredible. So listen, Dan is a wealth of knowledge, and so we're just going to jump right into it, right? And so obviously we know that. I believe it was last week or was it earlier this week? I can't remember, man. The days are such a blur now. That they obviously made some fairly huge monetary policy change where they knocked 50 basis points to prime. Can you kind of talk just a little bit about that? Obviously, I think we kind of know why they did it, but can you just talk about that a bit?
Absolutely. So one of the biggest questions, my phone's been ringing off the hook, as you can imagine, the last few days, because everything that's being reported in the news is that rates have dropped, which is true to a degree for sure. To talk about this, we sort of have to distinguish between fixed rates and variable rates. Variable rate, let's start with that. So variable rate is based on the Bank of Canada's prime rate, as we all know. If we have like a home equity line of credit, or if we have a variable rate mortgage, we're usually given a discount or an addition to prime. So for a mortgage, you might be like prime minus 50, and for a home equity line of credit, you might be prime plus 50. So when the Bank of Canada is lowering the prime rate, that has nothing to do with fixed rates. That just, impacts people on variable and HELOC. So if you had prime minus, again, last week, prime started at 3.95. Okay. Now we haven't seen any drop in prime in about 4 years. It's been, give or take, about 4 years. And we saw not only a 50-point drop last week, but we saw a full 1% drop, which is something that in my history of doing mortgages, I've never seen happen before in my life. So a full 1% drop. Now normally when prime rate moves, it'll move a quarter point. So it might move up a quarter point and it might move down a quarter point. So to see it move at 50 basis points on the first drop, and then to see it move again 50 basis points on the second drop that's almost unheard of. Right. So if you had a variable rate prior to the rate drops, okay, you'd still be getting prime minus. One of the things that we were waiting on, and one of the tricks the banks do, is the banks don't have to follow the Bank of Canada's prime rate. Okay, that's a misconception. We think the banks have to follow prime rate, but they don't. TD, for example, uses 15 basis points higher than prime rate when they calculate their variable and lines of credit. Now, you end up with the same net rate, but TD's prime rate was it's 3.1%, and prime today is 2.95. So if you were getting a discount before and you were getting, say, prime minus 50, well, that still applies. You're getting 2.95 minus 50 basis points. But one of the things that banks did to counteract this last week was, and even starting this week, is banks stopped offering discounts to their prime. So now what you're seeing is, before you could get prime minus 50, now on rentals with TD and RBC, it's just prime. Scotia is prime plus, I think it's 20 or 25, but they're prime plus 20. So if you do some manual calculations in the sense of, is the rate lower? The answer is yes, because 2 weeks ago when prime was 3.95, I was getting prime minus 50. So I was getting a net rate of 3.45%. Well, now that same deal, that same rental property, I would be doing prime plus 20. Prime today is 2.95, so that would bring me up to 3.15%. So it's a lower rate than where it was last week, but the discount has changed. That's how the banks are how they're counteracting that large drop in the variable rate.
Right. And so I'm sure you're probably getting lots of calls now on that saying, okay, they've dropped it. That means that it's going to be discounted right across
Correct.
the board. And now what about the fixed rate and the variable?
Yeah, so
Is
good
it,
question. So in retaliation, now fixed rates aren't priced by the Bank of Canada's prime rate, right? Fixed rates are based on the bond rates, and bonds are it's a more sensitive market. They'll move based on rumors, they'll move based on news and information. But the bond market reacted last week to the first drop, and fixed rates did drop. This is the first time I've ever seen this happen. And there's a lot of firsts that's going on in the last week or so, but
all right.
fixed rates dropped for a small period of time last week. There was a point where Scotia last week was offering, and I just refer to Scotia because we use them quite a bit. We use TD, RBC, they're all good, but I'll just reference Scotia. Scotia was at 2.89%. Then the Bank of Canada announced the massive rate cuts, and Scotia panicked and dropped their insured purchases to 2.34%. So you went from 2.89 to 2.34%. Well, on Friday, when the Bank of Canada announced that prime rate reduction again, Scotia, their bond rates, for whatever reason, went up. And Scotia sent out massive emails to everybody saying, look, our fixed rates are going back up next week. So now we had a small window to get 2.34 on an insured purchase. Now that rate's back up to like 2.79, 2.74.
Okay.
Same thing with rentals. Rentals got all the way down. I mean, again, it's still a great time for rates.
Right.
If you look back almost a year ago, Scotia's rental rate was about 4.24% for a 5-year fixed on a rental property. Okay. And then they slowly lowered over the last, year or so. They would go 3.89, 3.69, 3.49, all the way down to last week. They went down to 2.89%. This week, again, they're back up, but we're settling somewhere around 3.14% right now. So still lower, I mean, in hindsight, but not quite where it was last week. So we get a lot of calls from clients that are saying, look, should I break the mortgage? I mean, does it make sense for me to break the mortgage and take a lower rate? And the challenge with that is, I mean, it all sounds nice. Let's assume we locked into a mortgage at 3.99% and now rates are 3%. When we take a fixed rate mortgage, generally, if you read the contract terms, the penalty will be one of two things. It'll be 3 months interest, which is, that's when you have a variable rate. That's all the penalty ever is, 3 months interest. But when you have a fixed rate, it's based on interest rate differential or 3 months interest. And they'll tell you it's the greater of the two. So what that means in sort of layman terms, interest rate differential, look at this example. If you have a 3.99% interest rate and rates today are, let's just say 3% for the sake of argument, the bank's going to look at that negatively and they're going to realize, look, we have to break our mortgage that we have loaned out to you at 4%, and we now have to re-lend that money out at 3%. So we're going to lose money on that transition. So we're going to charge you, the client, the interest rate differential till the end of term. And that's where you start seeing things like a $15,000 or a $20,000 penalty. It's because the bonds are cheaper now and the bank is going to lose money if they have to break your mortgage.
Now, is there a particular product that you actually will tell your clients to move into, whether it's a fixed or a variable?
Well, one of the things we always do, it always starts with the conversation, because the intention of the property should be the first thing that you're looking at when deciding on your rate. If the plan is to break the mortgage, if you think, hey, I might sell this home, or if I'm in like a rent to own or something like that, and I know I'm going to break it, well, then I want flexibility, and I'd probably try to either match the term. So if it's like a 3-year rent to own, I might take a 3-year fixed. But ultimately, if I want control on my penalty, I would take a variable rate, because variable rate penalty is only ever 3 months interest. Now, if you're, I'm to the core, I'm a fixed rate guy. You know what I mean? I'm okay to sacrifice a little bit of a higher rate with fixed rates so that I don't have to worry when I hear rates are going up or rates. It's just one less thing for me to think about. So I think, it's been a little different over the past year because fixed rates have been a little bit lower than variable. But generally, we pay a little bit extra for fixed rates, and we pay for that peace of mind.
Okay. Now, one of the questions that I've been getting asked over the last week or so is, should I run out now and should I refinance?
Yeah, it's a good question. I mean, I wouldn't be, I would certainly consider it on the rate side. I think it would be tough to break the mortgage simply to get a better rate, because again, if you're in a fixed rate, they're probably going to get you on penalties. So what I would tell most people is, if you're thinking of breaking the mortgage and trying to get a lower rate, certainly start by calling your existing lender and finding out what that penalty would be. And they should be able to give you an idea. And then from there, I mean, it's pretty easy for me. If I have a client that comes to me and says, hey, Dan, I signed up last year at 3.99 and I see rental rates today are 3.14. Can I save money? We can easily run their numbers. I can say, okay, well, look, your mortgage balance on, 400,000 at the lower rate would save you about $100 a month. So if you have 48 months left on your mortgage and I'm saving you $100 a month, that's $4,800 total till the end of term. Now, you can't put a price on cash flow, because if the client says, well, I just want better cash flow, okay, that's a fair argument. But if you come back to me and say, well, my penalty is 10 grand, I mean, is it worth paying the 10 grand to, you know what I mean, to save the 5?
Right.
Well, then it just comes down to, what's the purpose of the refi? If are we looking to consolidate debt? Are we up for renewal? I mean, it's a great time to refinance. Forget the COVID-19 part. It's a great time to refinance because property values are higher, so it's easier to access capital, right? The markets continue to go up. Rates are still low. I mean, if you were to compare it, if you were to look at a snapshot of the last 5 years, you'd notice that rates are, give or take maybe slightly higher than where they've been, but there's been no major movement aside from last year. So from a numbers and timing standpoint, it's still a great time. I mean, we may have delays on process times and maybe getting an appraiser out there is some of the challenges I'm hearing. But as an overall, for sure, especially as an investor, if you're trying to get set up to go buy properties, I mean, now's a great time. You're sitting at home, looking for things to do.
and so look, and I think it really kind of boils down to this, right? Like, every situation is going to be different. Just reach out to your mortgage agent or the bank that you're dealing with, right? I think that's really what it kind of comes down to. Now, obviously, the big thing now is obviously with what's happening in the environment with COVID-19, and the government's announced that, the tenants, you can't evict tenants. So then now, if you have a situation where the tenants aren't going to pay for maybe a month or, maybe who knows how long this is going to go for, what about the deferral program? Have you heard anything on that, and how does that work?
I have, yeah. I've heard a bit about it. I mean, one thing we have to understand is that the government's made an announcement and the banks are now trying to scramble to figure out how to make it work. So that being said, what I'm hearing so far, and again, this is just, sort of rumor and word of mouth, but what I'm hearing so far is that the major banks, so the government announced yesterday that the 6 major lenders would consider deferring payments for up to 6 months to qualified applicants. Now, qualified is a pretty broad range. I mean, that could be somebody who owns a home and loses their employment and can't make the mortgage payment. This could be self-employed people who have to close shop and can't make mortgage payment. It could be investors that own rental properties and the tenants lose their job and can't afford to pay the mortgage. So my understanding is that with the 6 big banks, it's an easier process to get it done. It should, from what I'm hearing, it's a few questions that they ask if you qualify. If you do qualify, they will immediately put you into their program. Now, again, I haven't made the call myself, but that's what I'm hearing from the banks, is that it's not a critical screening process. It's more of just a few questions. Now, they will say everything is on a case-by-case basis because, of course, when it's, something like this happens, there's always risks that people take advantage of it. So they will do some level of screening, but the big banks, for the most part, from what I've heard in one day, have been pretty lenient. I mean, I know phone times and phone calls have been sort of backed up with the bank, so it might be hard to get through. But yeah, I mean, I'm hearing they're going through with it. It sounds like the monoline lenders, so anybody that bought with maybe one of the smaller lenders, or self-employed with the B lenders are also taking it on a case-by-case basis. So it does sound like it's open. The one thing that I would tell people where maybe it wouldn't apply is if you hold a private mortgage with a private lender. That might be the only time that it's not counting, because the private lender, I would assume, can recall that or can't recall the mortgage, but at the end of the year, they're going to want their term.
Right. And look, and I did call today just in regards to that deferral program as well. I called my bank. And so the message that I'm getting, and it may obviously differ from bank to bank, is that don't call unless you have a mortgage that's coming up within the next 7 days. And, and it's obviously because they're getting bombarded with calls, right? So they only want to deal with stuff that's coming up immediately, right?
Good advice. It's got to be, I mean, things like this happen. Everything, I think, takes priority, right? Everybody's got to operate by priority. So certainly they don't want their lines flooded with people who maybe, have 2 weeks, 3 weeks grace period. They got to focus on the people that need it right away.
Yeah, exactly. And I mean, look, and one of the things that I did as well too, and this might maybe even help some of the people on the call, is I just reached out to my tenants and said, "Hey, look, just want to see how things are going. You know, if you have you lost your job, are there any difficulties that you see coming up? When we get closer to the month, if there is, just give me a call, and then we can make a decision
I
at
did
that
the
point in
same
time."
thing. Yeah, I think
Yeah.
it's great. I always think it's great to maintain that sort of relationship with the tenants. So I did the same thing and let them know, look, I mean, we're all in this together and we'll figure it out one way or the other. So let me know if you need help.
Yeah, exactly. I think that's great advice. So, now with what's happening, are you still getting a lot of deals coming in? Have you seen any kind of a slowdown? Because I talked to Chris and Quinn today, and they're still seeing activity, some multiple offers.
Lots.
And things.
I think sometimes, I'm thankful I live in a little bit of a bubble because when, the perception is that the market might slow down, investors see that as an opportunity to buy more. So, you
Mhm.
know, directly, certainly I think it would be, we can expect some sort of a slowdown. I think open houses are going to slow down. You may see less offers on properties, but for anybody that's been looking at real estate since the start of the year, I mean, all I've been hearing is how crazy it is and how everything's multiple offer and back to offer presentations. So, I mean, even if you take 20% of those offers off the table, I think you're still in a position where you're getting multiple offers on properties. You still got a shortage of homes. You may have people that, you know, panic sell and sell their properties now because they're worried that the market's going to crash and they want to get top dollar. But I mean,
Right.
I've been doing this a long time, and I can tell you this year started off just like the peak of like 17. Like this was quite a
Yeah.
hot start. So something like this has certainly slowed things down. But no, it's still busy. I mean, from phone calls to people wanting to refi, from investors wanting to get pre-approved, from people maybe even not boredom, but maybe people are sitting at home figuring out, well, look, this is a good opportunity for me to maybe look at getting a line of credit, get access to some cash so I can go buy properties. So
Right. I
it's been
mean,
busy. It's a bit, and then, I mean, you mix in the rates are slightly lower, but you listen to the media and it's like the rates have dropped a full point and a half, and it's like free money to everybody. But
right, right. And that's why we
unfortunately,
got you here, right, to explain that, because yeah, some people don't know, they don't understand that.
for sure.
And so where was I going with this here? Because it's an important question here. In regards to that, I can't remember now. Anyways, we'll move on. If I remember it, I'll get back to it. But in regards to, a new investor that's looking to get into real estate investing, um, should they go to a mortgage agent or should they just go to their bank?
Good question. We get that a lot as well. Um, product to product, banks are all very good, right? There's not much of a difference aside from maybe interest rate from an RBC, from a Scotia, from a TD or a
Mhm.
CIBC. The mortgage wise, they're all the same. But where they really differ, especially for an investor, is, the way they calculate pre-qualifications, the way they look at your application when you have multiple rentals on it. Every bank is a little different in how many properties they're going to allow you to own, how many they'll allow you to own outside of them, whether or not they'll do it under a corp, a student rental. So by going to one bank directly, it's not that you're not going to get a good product, but you're only going to get answers that one bank can provide. So I'll give you a couple of examples. TD and RBC will only let you have 5 rentals total. That's their rule. Okay. Doesn't matter if you
Yeah.
have 2 to Scotia, 2 to CIBC. You can only go to RBC and TD and get 5. That's the max.
Right.
CIBC is at the other end of that spectrum. CIBC says, well, you can have as many as you want outside of us, but you can only have 5 with us. So if you're a qualified investor, okay, and your numbers work great, you're going to get an approval from every major bank. But if you just so happen to go to CIBC for your first purchase, your first 5 purchases, and they show you the moon and give you great rates, you've now locked yourself out from going to RBC or to TD because you're going to be at your max if you buy 5 properties. So for an investor who's trying to scale, just simply scaling, going to the different lenders is key because, again, everyone's banks. Scotia allows you to have 5 with them and 5 outside of them. So for an investor trying to build up to, say, let's say 10, 15, 20 properties, you have to go like TD, RBC, Scotia, BMO, and then CIBC, and that's sort of in order to maximize. Now, along the way, things like qualifications could get in the way. So again, every bank is a little bit different. So for example, if I'm going to Scotiabank and my investor has no rental properties, they just own one owner occupied and they're trying to buy a rental property, Scotia will use the highest rental offset on your first rental purchase. So you would have a very different pre-approval for an investor that had no mortgages or no rentals on their application. You'd have a higher pre-approval with Scotia than you would at CIBC, RBC, and TD because they're using a higher rental offset. Now, the funny thing happens after you own an existing rental property, those guys start using what's called a DCR. The DCR is basically like a debt service chart where they look at the rental income coming in on the property versus the expenses. They don't really look at, I mean, you still have to have some level of employment income, but they're more so looking at the DCR to see if the DCR services in terms of cash flow. Okay, and they will not use income as a backup. So when you get one rental and you're trying to now qualify for a higher pre-approval, TD, RBC, and CIBC will now qualify you using this DCR. The DCR is almost an 80% rental offset. So it's a much higher rental. So on your second rental property, you'll get a higher pre-approval at RBC than you will at Scotia, at RBC and TD. Excuse me. But again, that's, you know, it varies because every bank is a little different on how they're going to qualify you. So
right.
Scotia, against another example, Scotia will use the balance of a line of credit against you. So if you're an investor and you go set up a $400,000 or $500,000 line of credit and you want to use that to access funds to go and buy, some banks will count that against you. They count it as if it's maxed out. And we obviously want to know, well, what payment are they using? They don't count an interest-only payment. The rule with the banks now is that for any unsecured debt, so a regular credit card or unsecured line of credit, they count a 3% payment. So a $10,000 credit card or a $10,000 unsecured line of credit shows the bank a $300 a month payment. So it's a big liability. When they calculate a home equity line of credit, they use an amortized payment over 25 years at the posted rate. So make it simple, that's about a $600 a month payment on $100,000.
Right.
So if you're an investor and you go and set up a $400,000 line of credit, it's very possible that a bank like RBC or TD will give you the line of credit and then decline you on the purchases because your ratios are out. Your DCR might be out because you have that max payment on that home equity line of credit. So Scotia becomes very helpful for investors. I use them a lot because they really are the most investor friendly. They don't,
Yeah, I was going to say, I mean, listen, you answered that question perfectly because it's so complex.
It is.
I'm like, how am I gonna go and try and figure out if I should go to RBC first or Scotia first or TD? And so really, I think what you're really saying is go to a mortgage agent who, and not only just a mortgage agent, but a mortgage agent that's working with primarily real estate investors because,
100%.
because you know the banks inside out. Right.
And I would say to any investor starting out, the key to invest, not just with me, I always say the real estate agent's the most important, but you have to build a team of people that have experience in real estate. In investing in real estate. It's the only way to do it. And that starts with the real estate agent. It certainly includes a finance guy. You have to have a good lawyer and you have to have a good insurance person.
Right. And now look, I remember when I first got into real estate investing as well too, the only thing that was really kind of on my mind is, well, hold on, I can get a lower interest rate over here, or I can get a lower, and so you're trying to get the lowest interest rate. Talk about that, because I don't think everybody really understands that, just because it's the lowest interest rate doesn't mean it's the best.
So as an investor, I mean, this sort of ties into the last question as well, because as an investor, rate is something we're always conscious of. I mean, it's absolutely something we have to take into consideration, but it can't be the driving force for an investor, especially if you're trying to scale. Just use my example of CIBC that I just mentioned before. If you're an investor and you say, I got no rentals, but I want to get to 10 to 15, and I'm going to go to CIBC first because they have the best rate, then you're going to lock yourself out of those other banks. So the rate is important, but it can't be the driving force, because from that standpoint, you can limit yourself and you can limit your ability to buy. Now, another question I get all the time is I'm seeing, 2.29 or 2.49%. It's important for investors to know I tell them all the time, don't Google interest rates, because when you're Googling interest rates, for the most part, you're going to see owner occupied 5 to 10% down insured mortgages. That's not what investors are normally buying. They're buying 20% down rental purchases. So
Right.
there's a distinct difference when you're buying at less than 20% down. I mean, you got to, there's rules like 25-year amortization, mortgage insurance premiums, all that stuff. But the government made a rule like 4 years ago. They basically said no monoline lender in Canada can offer 30-year amortizations anymore. Okay, so there was a distinct difference between the two types of lenders in Canada. There's your big banks, and then there's your monoline lenders. Okay, and monoline lender is like a Street Capital or an MCAP or something like that.
Not one of the major fives.
Right, we're not one of the major fives. Now, they still offer great rates, but they're limited now. They used to exist to compete against the big banks, and they competed in interest rate because, to be quite honest, they don't have many other products, hence the term monoline lender. They have one product, mortgages, that's it. So they competed against the big banks at 20% down. They competed at 5 or 10% down. They would aggressively compete for interest rates against those big banks. But when the crash sort of started not the crash, but when 2017 hit and we had that little pause and all the rules started to change with mortgages, one of the first things the government did was they took the ability of those monoline lenders, they took their ability to do 30-year amortizations away. Now, anybody that's buying rental properties or buying investment properties, it's very beneficial for us to take 30-year amortizations, not just for the tax write-off portion of the interest, but it keeps our monthly payments lower, right? So our liabilities, when we go to qualify for more homes, keeps it at a maintainable level. When you start taking 20 or 25-year AMs, it's a higher mortgage payment, and that's going to start to affect your pre-approval. So when business sort of froze up for all of those monoline lenders about 3-4 years ago, 5 years ago, when people started to stop sending them the 20% down purchases because they couldn't do 30-year AMs, they basically closed up shop and they just said, we're not going to offer product anymore for the most part at 20% down. We're only going to compete in the market that is a level playing field. And a level playing field to our buyers or to anybody buying is a property that's being purchased at less than 20% down, 5 or 10% down. And that's because the banks don't govern the approval at that point. It's the mortgage insurer who governs the approval. So we're all limited. If we're buying at less than 20% down, we're all limited to 25-year amortizations. We're all limited to, well, I guess we can shop it around, but we're all limited to not having a lot of equity. One of the benefits of going to the big bank is they have products like home equity lines of credit. These smaller lenders don't have that stuff. So I know it's a long-winded question, but it really depends, on what you're trying to do. If you're a buyer saying, look, Dan, all I care about is the lowest rate and I'm just, buying an owner-occupied house, no problem. I can shop it. I can get you super low rate. We'll go to a monoline lender. But if you're an investor that comes to me and says, look, I only have 5 or 10% down. I want to buy this house, but I want to re-access funds in 3 to 4 years. Well, you may need to re-access funds through something like a home equity line of credit. And if you're not with a big bank at that point, you're going to be subject to a penalty to break it to access the money in your home. Right? If you buy a house and 3 years later, if I'm with a Street Capital and I've got 2.29 and I've got all this equity, I can't access that equity through Street Capital without breaking the mortgage. If I have a mortgage with a big bank and I build equity in my house, I can always go back to that big bank and access a home equity line of credit without having to break that first mortgage.
Who made that change again? Was that Bank of Canada?
Government, which changed.
Was it government?
25
where they knocked out the mono lenders?
The government.
It was a government change, right? Yeah. Okay.
Now, another crazy thing about 5 to 10% down is what I was saying about the rate online is that you are always going to find lower rates. And this sounds crazy to investors, trust me, but you'll always have a lower rate at 5 or 10% down than you will at 20. And that's simply because, number one, there's more competition, right? It's a level playing field, so there's more banks. And number two, the money's insured, so it costs less. Right? The bonds are cheaper for the banks to lend it out at less than 20% down. So they give clients the benefit of that, right? And in competition. So you will always get a higher rate at 5 or 10% down. And generally, my company does it as well on some level. We market towards first-time home buyers. So there's rates online that appeal to first-time home buyers, insured mortgages. But investors need to focus just on a little bit broader scope. I'm not saying rate doesn't matter at all. But the conversation needs to happen. When I meet with an investor, every conversation I have is how many properties do you want to buy? Because if the answer is over 5, then I strategically have to go to certain banks to make sure I can get you those properties. That's all.
Right. Yeah, you're mapping out a whole game plan for them, right?
Exactly.
You're putting that whole blueprint together. So that makes sense. Okay, listen, I got a couple more questions, and then I'm sure that there's people on the line that are probably going to want to fire some questions to you as well too. So, and then Chris, maybe you kind of keep an eye on that. So look, if you guys want to kind of maybe start thinking about some of your questions, you can either type it or you can unmute yourselves, and then we can fire them off at the end. So, I'm a nice guy. I'm sure there's a lot of people on the phone that are really nice as well too, right? Now, what about co-signing? You know, like should I, I got a friend who wants me to co-sign because they want to get a car, whatever it may be. Should I get into that, or should anybody in the line kind of co-sign?
You are a nice guy. I need a co-sign. No, I mean, co-signing, look, as long as you're talking to your finance person, like somebody like me, you should always, if you've gone through a pre-approval process and there's any major changes to your credit application, or you want to add any sort of a car loan or a debt, you should have that conversation with your mortgage or whoever you're dealing with for that, because that is absolutely something that can influence it. And I've seen it before where, a client will co-sign on a car that, shows up on the bureau that wasn't there before, and now all of a sudden the numbers don't work. So it can absolutely affect it. Now, doesn't mean you can't co-sign, because to be quite honest, if it's not affecting your approval and you want to be a nice guy, I mean, God bless you, I'd say go ahead. But certainly something you want to talk to the person who's in charge of your portfolio to make sure it's not going to affect your ability to buy. When it comes to co-signing for a mortgage, that can be a very powerful way to either add to an application, right? We get investors all the time that might come with half of a good application. And I don't mean that facetiously. Half of a good application could mean they qualify fully, but they don't have the down payment. It could mean they have the down payment, but they don't qualify. It could mean they have half the income they need and they qualify for half the property. So being resourceful, family, friends, certainly I've worked with joint venture partners that merge together and co-sign together to qualify. So, you want to know the people, obviously, that you're co-signing with. You want to know their debt load. You want to do your research and have some sort of comfortability. But absolutely, co-signing, especially on the mortgage side, can be huge because it can really, really impact an approval.
Okay. Yeah, no, that definitely helps. Now, what about this here now in regards to income? So, there's different incomes. Some people are hourly, some people are salary, some people are contractors, entrepreneurs. Can you kind of maybe just walk us or navigate us through those type of different employments?
Well, income, this is, for anybody in finance or anybody who's done a mortgage over the last little while, getting your income documents or getting your down payment documents have to rank up there as the two worst things you have to go through. But every bank, again, depending on the deal, it's different. So let's talk about employment income. So the banks generally, and there's usually, there's exceptions to every case, I'll try to touch on them, but generally the bank will use some sort, like if you're a salaried permanent employee, they will use the base salary as long as there's no probation. So, if you started a week from today, if there's no probation, the bank would ask you for a job letter and a pay stub when it comes in, and they'd use that full income as long as it's a permanent. That's the key word. When you are on probation, you have to wait for the probation to pass. So that's your salary. Now, that works the same as a permanent hourly employee person, right? So if you're, 40 hours a week, $21 an hour or whatever it is, as long as there's no probation, the bank will take that math formula and figure out what your income is. Where it starts to get a little complex on top of that is, if your commission, or if you get car payments through your work, or if your bonus structure, or if you work overtime. So the way that this is an insurer rule. So when I say everybody has to play at a level playing field at less than 20% down, the mortgage insurer is the one giving you the approval, right? The bank will look at all your numbers and all that, but they have to kick it to the mortgage insurer for the approval. Now they have specific rules on overtime and things like this. So it's pretty much the same at every bank you go to if you're buying at less than 20. And the rule is you have to have a 2-year history of that set income. So if it's commission, if it's bonus, if it's overtime, the bank will want to see a 2-year history. Now, I say history because it's not an average. It used to be a 2-year average of the income. But now what the banks will say is, no, it's not a 2-year average. We will use a 2-year average if your more recent year was higher than the previous. So if your 2018 was $100,000 and your 2017 was $80,000, they'll use $90,000 average. But if your 2018 was 80 grand and your 2017 was 100, they're only going to use 80. So that's where it starts to get a little bit more, ticky-tacky in terms of the rules. Nurses, for example, nurses are great. I mean, nurses can work all different capacities. They could be a full-time nurse with guaranteed hours. They could be a part-time nurse with working 40 hours, but only guaranteed part-time hours. They could be, completely casual, not guaranteed any hours and working up to 40. So one thing that's important from a finance perspective from mine, and this is, if anybody listening has gone through an application and wonders why we ask for so many, not a ton, but we ask for so much income information up front, is because we have to be very specific with our investors. I mean, we run into situations all the time where a client will call and say, well, I'm making 70, 80 grand a year and my credit's perfect. What can I qualify for? And there's a lot of people that would just run the numbers based on that and say, okay, well, quick math, you're about 5 times your income. So 7 times 5, you're about $400,000 as a purchase price with 5% down. And the guy will go out and buy. But that doesn't necessarily mean that's the income I can use to qualify you. If that 70 grand is a contract is the same thing as the 2-year. If you're a LTO or you're a new teacher to a new district, you got to have a 2-year history. They won't use a 6-month contract. So right. Income is very, very important. And it's important for your finance person to understand what your income is. Again, some people are easy, it's salary, but other people are, contract, that's a 2-year history, overtime hours, 2-year history. And then self-employed people will have the biggest challenge with those big banks, because the big banks will look at their T1s and they'll just look at their net income after taxes. And for the most part, for the self-employed person, especially if they have some sort of a corporation, they're not paying themselves a lot of money. So that provable income is going to be hard to show. But right. The answer for most of those clients is to look at B lending. B lending doesn't look at your provable income, your taxable income. A B lender is going to look more at your bank deposits and what's going into your bank account. So, if you're a contractor and you've got, 5,000 going in a month here and 10,000 going in the next month, and, you're writing it all down to a 20K income at the end of the year. Well, a B lender will just look at a 6-month snapshot of your bank statements and look at the income going in. So if you have 100 grand in deposits going into a bank account, a B lender will double that and then take a little bit away for deductions. So 100 grand in deposits over 6 months to a B lender could look like 150 grand in income to them. Whereas you might only be showing, 20 grand, 30 grand at the end of the year. Right. Now, of course, a B lender has a little bit of a higher rate. Today, they're give or take around 4.5%. But if you were to do the math on, again, every investor is different, but let's assume this particular investor that I'm talking about is only showing 20 grand and I need them to show 100 grand to get their numbers in line. Well, look at what you're going to pay in tax to get your income up to a point where you would qualify with the A lenders, right? If you have to show 100 grand in income, you might be paying 40 grand in taxes, and not just for 1 year, it's 2 years. So now you're in 80 grand in tax money just to get your income up to a point where you will qualify with the A lenders and say that you have best rate. Well, in my mind, for the self-employed person, take the higher rate at the B lender. Even if the mortgage payment's an extra, even if you say $300 a month, which is probably closer to $250, but let's just say it's $300. That's $3,600 a year in extra mortgage payments. The only extra fee the B lender is going to charge is a lender fee of 1% in the first year. So that if you pick a 1-year term, you don't have to pay that lender fee in year 2. You just pay a small renewal fee. So for the self-employed applicant who's got sort of maybe a lower provable income application, the answer for the most part is go to a B lender. They require 20% down for the most part, but you'll find the cost is way cheaper.
Now, is that part of stated income as well too, or no? Is that something completely different?
Yeah, that's basically what stated income is. You're basically telling the bank what it is you make. And that stated income is like a term that A lenders even used to use. I mean, people who've been buying investment properties for years would know that term, because A lenders used to do it 20% down. Just tell us your income, we'll approve you.
But that's something that's kind of made a comeback, correct? Didn't they get rid of that for a number of years?
Not the A lenders still haven't brought it back. I mean, 20% down with the A lenders, you still have to fully qualify nowadays. But the B lenders have always sort of been this. I think what we've seen in the last little while, because again, I've said over the last 4 years, I mean, certainly there's been some, small changes in rate, but for the most part, rates have just gone up. Maybe in the spring they drop a little bit, but then they go up. So it's, I mean, it's, we're in a good cycle right now.
All right, beautiful. Dan, listen, thanks a lot. I'm going to open it up to the floor. Chris, I don't know if we've got any questions yet.
Yeah. But listen, man, Dan, that was incredible.
It was.
You know what it is? It's, you know what, frankly, because most people don't get this kind of in-depth information.
Yeah.
Right. And no, frankly, to be honest with you, it's probably way over most people's heads. And that's fine, because that's what you're there for, right?
Yeah, I think that's a great point. Yeah, and I try not to talk too fast, so my apologies if I move. Sometimes I'm thinking like different, this bank does this and this bank does that, and I think it's so far ahead I forget what I'm talking about in the moment.
Yeah, no, it's perfect. But again, that's what you're there for. That's what we enlist you for, because we don't need to know all that stuff. Right?
No.
You just got to trust the person that knows that stuff.
Yeah, I just got to tell you the plan, right? So
yeah.
Okay,
that was good.
So listen, question from Alan. He was asking about potential investor JV, for example, who could show the down payment and has solid credit, but has low income. Are there lenders, for example, out there that might be able to help him out based on a rental income?
Yeah, I mean, B lenders. I've done deals for clients who have just multiple rentals. They don't have any income. They just have rentals, and they calculate it on their rental income. You'd have a hard time getting the A lenders to qualify you with no provable income, but certainly B lenders, and if not, there's private lenders. But in a situation like that, I would get into it and say, why is the income low? And if it's because, well, I buy properties and I flip them, or, I buy them and then I hold them and I buy them for cash. Like, I'd have to find out what sort of income it is, but it's definitely a way to get it done. If you have 20% down, there's always a way to get it done. It just might be expensive if you have to go private.
Yeah. Okay. All right. Listen, Alan's got a follow-up question, and he's asking for a friend here. Right.
We know what that means.
Yeah, we know what that means. Any lenders out there who may not report the mortgage to the credit bureau?
Yeah, there's still monoline lenders still aren't showing it on the credit bureau. So, big banks will. If you're the big bank, for the most part, you're going to show on the credit bureau. But the monoline lenders and the B lenders don't show up on the credit bureau right now, as of today. Not all of them. And if you buy under a corporation, generally that won't show up on the credit bureau either.
Interesting. Okay.
Yeah.
All right. Let's see. From T says, how do lenders pre-approve you for pre-construction projects which close 3 to 5 years from date of purchase?
You know what? That's a very good question. So, believe it or not, most people don't. They don't pre-approve you. I mean, when you're buying a pre-construction, the one thing you have to understand is that when the builder is demanding a letter that says you're approved, that letter it means nothing. It's air. Most banks will just give you a pre-approval letter that says, here you go, you're pre-approved, but come time of closing, you have to qualify for the mortgage. So one thing most people are doing, if they're buying a pre-construction now that's closing in 3 or 4 years, they're usually meeting with the finance person to make sure that their numbers would qualify today to buy that property. And if not, then they may need some direction on how to get their finances in order. I mean, sometimes income will go up in time and, income will rise. Sometimes it's adding a cosigner. But for the most part, the answer is you don't qualify today. You just look at a pre-approval, and a pre-approval is somebody who's just looking at your numbers, But there is one bank that will do a full approval today on a pre-construction. They'll even do the appraisal on a pile of dirt, believe it or not, and that's RBC. So RBC is one bank that will look at a pre-approval today on a pre-construction and approve you today without asking for any more documentation at the closing date. Maybe just some signatures, but they're not going to look at your income again. They're not going to look to see if you bought any other properties. They're just going to qualify you at today. And if it works, they'll hold the rate. Now, you can go back to them. If rates are lower in 3 years, you can go back to them to negotiate the rate without having to go through the pre-qualification again, or the qualification. But yeah, that's sorry. I saw something pop up here.
Yeah. Now, Dan, in regards to, the climate that we're in today, I don't know if you do a lot of pre-construction, but over the course of the next couple of months, do you anticipate any potential issues where now somebody's been laid off, or where does that go? There's so much murky water there.
It really is. And I had this conversation with one of the VPs at Scotia today because, I was just how are things going? And he was telling me, we're calling job letters today and people are getting laid off and we're having to close the deals because what are you going to do? I mean, not close the deal now? So,
Okay.
Again, something like that, it's hard to say because it's not like I can stand here and say nobody's going to have any issues with something like that. But I think it's something that certainly the banks are aware of. I mean, this is, that this could lead to obviously layoffs and, some sort of shutdowns at businesses and things like that. And income and employment will be affected for buyers. But it sounds like, everything that I'm hearing is that the banks are looking to work with people in this. Nobody, they're not looking to leave people out in the rain. People aren't going to be homeless. Like it seems so far, that everything's workable. But yeah, I mean, look, I would anticipate, I was talking to my partner Dave about that earlier today. I would anticipate that as we continue, there'll be more of those. One thing that, is concerning as well is that if there is sort of a pause in the market and values aren't going up as much, there's always the concern of appraisals, right? This was something that we never really saw much issue with back in all the way up till 2017. But now you get into a market where, again, you're in multiple offers, right? The property's listed under value, so it's driving these bully offers and people coming in. And what we were seeing in 2017 was people were going in with firm offers, firm bully offers. And when the appraiser was finally making their way out there and coming in with a lower value, you buy a home for $450, let's say, or that house is listed for $400, the true value is $450, but you go in and put in an offer at $500,000 because it's over everybody else. You'll likely make the money back, but you got to get this house, so you're in firm at $500,000. Well, the property still has to get passed. So if the bank was to order an appraisal and the appraiser went out and said, yeah, it's not worth 400, it's worth probably closer to 450, you're now on the hook as the buyer to come up with the difference because the bank will now only fund 20% down of the purchase price. They won't give you, 20% down of the appraised value. They won't give you 20% down of the purchase price anymore. So appraisals is something that, we just want to be cautious of, in a market where, there's a little, instability in terms of where we're going forward right now. I would just be cautious with something like that. That's all. Firm offers are always, I get it. Look, like I know the realtors, Chris and Quentin are probably looking at me like, man, the market's nuts. You can't put conditions in. And I understand that completely, right? I get that. But from a financing standpoint, those are the risks involved. That's all.
Yeah. But Chris and Quentin, I think for the most part, we're still getting our conditions incorrect.
Oh yeah,
Yeah. So
100%, right? Yeah, that's reviewed with the client. The client has to have clear, crystal understanding that they're choosing to waive the finance condition, not us.
And most times, if you're working with good realtors like you guys, there's creative ways to come up with different conditions, and you know what I mean, and make them the limited conditions rather than have a whole offer with 4 or 5 conditions in it. So again, another reason why the agent's key.
Well, though I do think sometimes, because especially with some of these agents that have been around the block, they're going to still be suspicious of offers with no conditions.
Yes.
Right. Because assuming it firms up, hey, that's fair. It's a firm offer. It sounds great to the sellers. Sellers love that.
Yeah.
But now what happens come closing time, right?
Yeah.
Now it's a real problem. So a lot of times these sellers, these listing agents, they're happy with conditions.
Yeah.
Right.
Yeah. They know people are doing their diligence.
Yeah. All right, Chris. So we got to see if we can speed through some of these questions here because they're flying in.
Let's see. I don't know, Gary. You have? Can you see them?
Yeah, I can see them.
Okay.
All right.
Yeah. Go ahead.
Okay. So where do you see primary going in this COVID-19 situation? Do you see Banks of Canada and Department of Finance throwing the kitchen sink to try to save the Canadian economy by moving interest rates negative or zero? That's actually a good question. Or putting Canada in huge debt through lots of government bond issuance. What does this mean for mortgage rates and housing markets? Will they continue to slide lower? Do you think that housing prices will go lower? Yeah.
Honestly, in terms of the values and the questions on the streets, I would defer to like Chris and Quentin on stuff like that. They've probably got a little bit more, knowledge in terms of that sort of thing. But what I can speak to is the interest rates. And it's a great question because, and the easy answer, if I can be easy, is we really don't know what to expect. We've never been through something like this. And I think if I was to predict, I would assume that prime rate will at least stay the same. I mean, I don't think it's going to increase. I think if anything, you're probably right. It may decrease another quarter point. But again, I was saying that before it dropped the 50 points on Friday. So I think we're fine with rate. I don't think rates are going to be going up in terms of the prime rate, but it's very possible that the fixed rates continue to fluctuate a little bit up, a little bit down. But prime rate, it could drop another quarter point. I think that's probably why the big banks are taking measures to change their discount to prime rate right now, as an anticipation of that happening. So yeah, I do. I think prime rate maybe by the end of the year will drop again.
Okay. And I guess maybe just to answer that last question, part of it anyways, do you think that housing prices will go lower, Chris Quinton? I mean, you guys are still seeing multiple offers out there, right? You're seeing listings coming up every day out in Peterborough, right?
Listings coming up. There's buyers out there like crazy, and I think this is just going to feed them, right? The lower rates, or the perception of lower rates, whatever it is, I think people are going to continue to purchase. All right.
Well, and let me just, you just reminded me, one thing I forgot to mention completely, which is a big change to the market too, is the stress test is changing on April 1st. So when you say lower rates, it's not even necessarily the interest rate they're getting. The qualifying rate for buyers is changing on April 1st. One of the rules we made, everybody's probably heard the term stress test. When you're buying a mortgage today, you have to qualify at the stress test. Well, the stress test rate today is 5.19%. Okay, so when I run somebody's numbers, I have to run it at 519 to see if they qualify. Well, come April 1st, they're changing that rule to be 2 plus the contract rate. So if you have a contract rate of, say, 2.74%, you're going to now qualify at 4.74% rather than 5.19%. Now, in dollars and cents, that could lead to an extra, 30 to 40K in pre-approval amounts. So, I mean, everybody's pre-approval, their bottom line is going to be increasing come April 1st.
Okay.
Yeah, absolutely.
Yeah. All right, cool. What other questions we got there, Chris?
Let's see. Actually, I like this one from James. Do you think that alternative lenders might be at risk of going out of business or bankrupt if the economy goes into a recession? In other words, is it risky maybe to go to these lenders if they're not well capitalized in order to borrow money?
No, I mean, look, if anything like that happens, there's always consolidation. If one of those smaller lenders was to close up shop, look at Street Capital. They got bought by RFA. So what happens in any of those situations is another bank just comes along, buys their book of business. And to us as the customer, things just continue on, just with a different name, taking the money out of our bank account.
Yeah.
Okay. Yeah, no, that's good. That makes sense. I have a piece of land that I want to build a cottage on. What would be the best way to use my HELOC or construction mortgage?
Good idea. I mean, honestly, the best way you answered it is to use your HELOC. It's the cheapest money you're going to get. And not only that, you have control over it. So if you own a plot of land outright and you're looking to finance the build, you can get a construction loan. And a construction loan is a little bit more controlled, where you can arrange some sort of a private loan against the land that you own. And, they'll advance funds as the construction goes, as you break ground and as you build the framing, they'll release the funds to you. Now, it's usually at a cheaper cost. And again, you don't have control. If you need more funds on Friday, you can't get it. That's just the way the construction works. So the benefit of the HELOC for sure would be that you have the access to the money, and the rate is likely lower. I mean, we talked about prime rate being down. Most lines of credit are at prime plus a half. So if prime today is 2.95 and you're going to borrow the money for the renos at 3.5%, that's the cheapest money you're going to get. And then when the property is built and ready to go, you can refinance the property once it's built, because now it's a home and you could fit it in with the bank's mold of what they want, and pull the money out and pay back the line of credit.
Cool.
PCI was asking, do you think now again, with these things might be changing, so I'm just throwing out the question as is. Do you think it's a good idea to take advantage of the 6-month deferral program with your rental properties?
I think it would be situational. I mean, if you're an investor and maybe you're in some financial despair with what's going on and your tenant is, I mean, certainly it would be something to take advantage of. I mean, I don't think it's a negative, but, obviously the goal here is to, pay down our deductible debt and pay down our non-deductible debt and leverage our deductible debt. So, I mean, if we can maintain the payments and maintain that, I mean, that's the goal during this, is to not change, not have status quo. I mean, also, obviously there's circumstances for everything, but it would just be a case by case. I don't think it's a bad idea. It's certainly there for people that need it, and this is a time where people might need it. Absolutely.
And I think it kind of goes back to what you said earlier as well, too, right? I think it's based on if you qualify for it.
Right.
And so if the tenants are still paying and you can't prove there's any kind of hardship, you may not qualify, right?
Correct.
So.
Correct.
Yeah. Let's see, where are we at here? If you currently have a property closing end of April, what would your advice be? Come to the mortgage. Hold on. Yeah, if you're currently looking to close on a property at the end of April, what would your advice be when it comes to the mortgage if you're looking for a refi within 3 to 4 months after close? So you close and then you try to refi quick, fast.
Would this be for like a burst strategy? Is that what I would, most people that ask me that are asking because they want to buy it, they want to reno it, and then they want to rent it, and then, right? And refi and then rent it out. So
yeah, that's exactly what it is.
Okay, good.
For a secondary suite.
Yeah, we do a lot of those. We set up a lot of mortgages. I mean, I think the key is, number one, there's a few, I do, and I'd be happy to do it for any, all you guys one time on Gary's team. We do a BRRRR presentation. And from my standpoint, it really just depends on how you want to structure the mortgage. And again, it comes down to the timeline. It comes down to the cost. But the easy answer is if you were going to structure it, I would try to structure it in some sort of a combination of a line of credit and a mortgage rather than do an open mortgage. Most people will tell you to do an open mortgage because there's no penalty to break it. The problem with an open mortgage is the rate's going to be crazy high. It's going to be like 5, maybe 5.5%, just depends on the lender. So the rule in Canada is when you're setting up a mortgage, okay, let's assume you're buying with 20% down. So we're going to leverage 80%. The max amount you can have on that amount is 65% in a line of credit. So 65% of that 80% can be in a home equity line of credit. Okay. So if an open mortgage is 5.5%, and I need to beat that rate. Let's just imagine this. Buy a house for $500,000. Okay. We put 20% down. We're left with the mortgage amount of $400,000. Okay. Out of that $400,000, I can put 65% of that into an open line of credit at that's lower. It's 3.5% today. So 3.5% I can borrow. I'm going to pay interest only on that HELOC. The remaining 15%, the rule in Canada is it has to be set up in a mortgage. So quick math, you're probably looking at around 80 grand. You're looking at 320 in a line of credit and probably 80 grand in a mortgage. But the way you would structure the mortgage, you put the $80,000 mortgage into a variable rate mortgage. And then whoever your mortgage broker is, or probably not at the bank, but if you're working with a mortgage broker, somebody like me, I would pay my client's penalty on the variable. So there's virtually no penalty for the client to break that mortgage. They're going to have an open mortgage interest only payment on the line of credit portion, and then they're going to have a variable rate on the lower portion, but I'll pay the penalty on that.
Okay.
Yeah. Hey man, some of that went over my head.
I was worried about that. I could try to simplify it.
No.
Look, I think it just justifies even more why you just need to go to a specialist, right? Like yourself.
I could pull up my phone and do quick math if you want. Like imagine this. Let me try one more time really quick. 500,000, okay? 65% of that is 325,000, okay? So I can put 325,000 into an open line of credit at 3.5%. The remaining amount, remember, we need a total of 400,000, right? Because we bought for 5 and we need to borrow 4. So 325 in a line of credit, that leaves a delta of 75,000. That 75 we put into a closed variable mortgage. Now the total you owe is 400,000. 325 in a line of credit, 75,000 in a mortgage. I'll pay the penalty on the mortgage to break it. So the question who's being asked, you should have no penalty, but you should be breaking it up to save cost into a line of credit and a mortgage.
There you go.
Okay.
Appreciate that, Dan. Thanks.
No problem.
So we got like 2 minutes left. See if we can bang out 2 more questions. All right. So when building a portfolio and using the BRRRR strategy, is it better to go fixed or variable, considering that we would be refinancing in the future?
Well, again, same thing. That's the exact same question, right? Like we would, depending on the timeline of the renos, because there's different ways to set up the BRRRR. I mean, there's a program called Purchase Plus Improvements where you can get the renovations reimbursed to you by the bank.
Yeah.
So there's different programs, but again, variable for sure for flexibility. But if the plan is get in for the first, 6 months and then break the mortgage, it would be a hybrid of a line of credit and a mortgage, because that's the cheapest you're going to borrow. If you put it in a variable rate, remember, if the full 400,000 is in a variable rate, well, let's think about this. The payment's about $400 per 100,000 on a 30-year amp. Okay, so a $400,000 mortgage is going to be about $1,600. Okay, when you go to pay a penalty, your penalty is generally 3 months interest. So 3 months interest, give or take, is half your payment. So half your payment times 3 is $2,400. So you're going to pay on a variable closed rate, you're going to pay a $2,400 penalty to break that mortgage. Now you'd say, okay, well, put me in the open mortgage, but the open mortgage is going to come with a 5% interest rate. So now you don't pay a penalty, but you're paying 5% for however long you're in the mortgage for. If it's 6 months, that could be an extra $200-300 a month. So again, just having a broker that knows how to set it up with the HELOC and the mortgage portion is easy, because to the client, it's all the same. They just need to know the mortgage payment, right? But it's all coming out of the same, it's all tied together. You're just getting the benefit of the lower rate, the cheapest payment. Because remember, the interest is deductible. So there's nothing wrong with an interest-only payment, right? We get to deduct all that. So some investors prefer the interest-only.
Here's an interesting question here too. So with these lower interest rates and lower variable mortgage rates, do you think people will look at buying now instead of renting, making it more difficult to get your property rented right now?
No, I don't think so, because the qualifying is still the same. You know what I mean? So I don't think, certainly one way to stimulate the buying market is to lower interest rates. I mean, that could be the single biggest impact to get more people out buying, is lowering interest rates. But again, the truth is that rates aren't much lower than where they were about a week or two ago. They're not. There was a blip where they were, but they've adjusted. So no, I mean, look, anybody trying to get a new variable rate mortgage is not going to get the same variable rate discount they may already have. So again, if you're getting prime minus 80 today and you're thinking, look, I'm at 2.95% prime minus 80, I'm at 2.1%, then you're not going to get that rate. That's all. The math wouldn't work. You're going out and buying at 3.2%. That's the rates today, 3 to 3.2. So I don't think it'll drive many new buyers to the market. It might stimulate some phone calls for sure, but
yeah. All right, Chris, want to fire off one last question and we'll wrap it up?
Yeah, well, I think you answered mainly most of them, but Sean was asking about the stress test changes. You said April 1st. Is that not been delayed? He was asking.
Oh, maybe it has. Honestly, I've been so tied up in stuff today, or I haven't heard anything that it's been delayed, but maybe it has. I could double check. I'd have to just look. But as of yesterday, I haven't heard any changes to that, but it's very possible.
Yeah.
Okay, cool.
Thanks for the tip. Something to look up when I hang up.
Yeah. All right. Dan, listen, thank you very much for your time. I really appreciate it. Thank you guys all for joining this call tonight. And listen, I hope you guys got some great information from Dan. I know I did.
It's great.
Yeah, it was good. And listen, you know what? We have lots of time on our hands, so maybe we'll have you do a burst strategy next Monday or something.
Yeah, no, happy to. I got that presentation ready for you, Gary. So no problem at all.
All right, cool.
All right, thank you, everybody. It was great. I really appreciate you guys having me on. Chris, Quentin, Gary, you guys are all awesome. So thank you very much.
Thanks. And listen, if somebody wants to get a hold of you, Dan, what's the best way?
Email would be best. I mean, my days are, sort of jump from one file to the other, but I'm very quick on email. If anybody wants to reach me, my email address, it's a bit of a long one, but it's daniel.patton@butlermortgages.com. But Gary, Chris, and everybody, they've got all my emails. So, feel free to reach out to them and they can certainly put you in contact, and happy to reach out. So thank you.
Yeah, and listen, when you send an email to Dan, that guy is great on emails. That's the best way to communicate with him. He's just like bam, bam, bam. So reach out to him. He's a wealth of information. Dan, thank you very much. Chris, Quentin, thanks, guys. Appreciate it. Arlene.
Thank you very much, everyone.
All right. Take care, Dan.
Bye-bye.
Bye.